Gautam, Duggad of Motilal Oswal joins in now to talk about his report that he has released on the expectations from Q1 and his view on individual stocks and sectors. Gautam, hi, good morning. Before I ask you about your overall view on Q1, I was going through your top picks and Infosys features as one of them. I wanted your thoughts on what you've made of TCS's numbers, the cautious commentary from the management more importantly, and do you expect this to be a weak quarter for Infosys as well?
Sonia, good morning. This quarter is anyways expected to be weak for entire Tier 1 IT because of the margin pressures. What is positive, however, is the demand scenario from a medium-term perspective. Now, TCS has put a lot of emphasis on second quarter numbers because that will decide whether their FY20 will end with a double-digit revenue growth or not. Our call on IT is more from a top-down perspective, more from a defensive approach right now, because we are finding lack of earnings growth in most of the sectors barring banking. And in that context, IT offers a reasonably strong play, a very strong management quality, very good balance sheet, 30-35% ROE and 7-8% earnings growth, with valuations not cheap but at the same time not prohibitively expensive compared to other defensive sector. As you can see, consumer is extremely expensive. Pharma, in my view, has ceased to be an defensive sector since last 3 years. So IT offers the only sensible defensive play in today's context of the market, and that is what is driving our preference for some of these Tier 1 IT names.
Okay. Good morning, Gautam. When you were preparing your earnings report, where did you have to trim EPS expectations?
Two sectors, Lata, and no prizes for guessing it. It's auto and metals. Okay. Auto we've trimmed by double digit again. So we are actually now at 235 to 40 for Maruti for FY20. Almost a 10-12% kind of an earnings cut for Tier 1 auto names, be it Mahindra or Eicher or even for that matter Maruti. And secondly, metals, which we've been highlighting for almost 2 years now, that FY20 will be a year of big earnings decline for the metal sector given the lack of excitement in the commodity prices. For the quarter also, we're expecting virtually 40% earnings decline in metals pack. Though metals is not a very big part of the index, but from a quarter's perspective, if you look at the earnings cut of 3% that we've done for Nifty, a large part of it is accruing from auto and metals. I want to still speak about earnings, but broadly in your report, you all are positive on banks, and again, no prizes for guessing that. That's what everyone is positive on. But are all the negatives for banks sufficiently accounted for? The NCLT money is not coming at all, the SR or whatever. Recovery is not what one thought it would be. And there is still cleaning up. You realize there's possibly a haircut in DHFL. We don't know whether there will be haircuts in some other NBFC or HFC names and maybe real estate names to whom these NBFCs have lent. Now Goldman Sachs is speaking about retail home loans also that could be affected. Will there be shocks over there? Even if the overall, year on year will be much better, can there be some trimmings? There is a very high possibility of that happening. That's why the earnings narrative of bank itself has got pushed back to 2H versus 1H now. So we've been seeing delay in resolution of a lot of NCLT cases, and that continues. So far we have not seen any big write back yet in FY20 or even 2H FY19. What is, however, important is also to note the other counterbalancing force, which is the trimming of bond yields. That will provide some succor to the PSU banks, especially big banks like SBI. And relatively ICICI and Axis, I would say, are insulated from what is happening to the other broader market PSU banking space. So that's why when we look at the corporate bank space, if you look at FY20 also or 1Q FY20, entire growth in Nifty is predominantly led by banks. If you remove those three banks in Nifty 1Q FY20, there will be a 6% earnings decline. Similarly, FY20 full year, if you remove those three banks, the growth comes down from 20% to say 6 or 7%. So I agree that there is a possibility that there could be some trimming of estimates, but on balance, it will still look better on a YOY basis for the entire FY20. We have to wait and see how this quarter pans out and what the management commentaries are, particularly on two factors: the new stress cases that we have seen, and also the guidance on write back of a lot of these NCLT cases.
I wanted your thoughts on Titan as well, because that is one of your top picks. The management did say that they're going to do only about 13% growth. They had guided for 20% earlier. Would you keep the faith here, or would you churn out of this stock?
No, absolutely. This is a quarter that one should look forward to, because if you wanted to buy and you were scared of valuations, this allows you an opportunity to get into a very strong structural story where market share expansion is happening almost on a regular quarterly basis. Plus the fact that it remains a very big industry, and you've seen how the last 3 years have been for Titan when the unorganized players have been decimated. So 20% of top line growth for last 2 years with incremental margin expansion. I think the earnings story remains extremely solid, just that the valuations had got ahead of themselves. So this kind of event or this kind of commentary does allow people who are looking to get into this name but couldn't because of this high valuation to now get into this. Still remains our top consumption idea.
Okay. And how are you tackling this unexpected, well, not so unexpected issue in airlines? Whatever you thought about Indigo now goes to SpiceJet?
So Indigo, we've been very neutral on the stock because of the valuation concern and the significant volatility in the crude oil prices. Obviously, this event does create a lot of uncertainty because we've just been through jet. There is a problem in the whole airline space, and this would have served as a very good opportunity for Indigo to gain huge market share, but now they find themselves in some of this distraction. So obviously it offers opportunity for SpiceJet to basically gain market share. However, the last word is not yet spoken on Indigo, so we'll have to see how the developments pan out there. But it does create unnecessary distraction for them when the whole operating dynamics of the sectors were so heavily stacked in their favor.
Well, to be fair, now the market is also not at 12,000. It is at 11,500, and mid-cap index has been the underperformer of 2019. So some of the bad news is there in the price. Which stocks are you going long with into the earnings season?
Yeah, but Lata, earnings are also not at 620 rupees of EPS now. We are at 584. And valuations are still at 19.5 to 19.8 on FY20 Nifty EPS. So valuation cushion is not there for Nifty, even though in the last 1 month with 70-80 bips kind of bond yields, it does offer some cushion to equity valuations. As far as stock and our model portfolio construction is concerned, been very defensive. If you see our model portfolio this quarter, we have raised almost 7 percentage point increase in defensive stocks. So we've increased weightage on HDFC, we've increased weightage on NTPC, we've reintroduced ITC in the model portfolio, and we've also increased weightage on some of the other defensive names. So overall approach is still to stay focused on defensives, to stay as close as possible towards earnings visibility story. On mid caps, I agree with your point. In fact, we did point out a week back that mid cap valuations are now turning at a discount to large cap of almost 15 to 20%. After staying at a premium for large part of 2017 and 18. But the problem with mid-cap is valuation alone doesn't suffice for their outperformance. You need a very strong market backdrop and positive news flow along with corporate commentary. That currently is missing. It does allow you some headroom to pick bottom-of ideas, and that's what we've concentrated on. So we've highlighted a couple of names like Federal Bank, DCB. No changes there. Incrementally, we've added ABFRL. We've been positive on Crompton Consumer, Oberoi Realty in those spaces. So vis-a-vis 6 months back, mid-cap valuations do offer some breathing space now. But unlike 2013, which is when if you stretch back the spread between large cap and mid-cap, you will find similar spread existing only in 2013 June. That point of time, you had an absolute cheap valuations for mid-cap. Right now, the valuations are cheap only relatively.
Okay. Well, I could have gone on for half an hour, Gautam, but we are out of time. I'll add your other mid-cap ideas. MMFSL, Indian Hotels, Agrovet, Godrej Agrovet also form part of Gautam's mid-cap list. Thank you very much indeed for joining us and ushering in the earnings season analysis. As it were, we are going to take a break and then concentrate on the sectoral, or what we call the QSQT analysis. Today, we are going to analyze autos. Sonia is at that perch where she'll be telling us what to expect from auto earnings. Jay Kali of Elara will also join us.